All right, welcome to this explainer. Today we're going after the big one. We're attempting to unlock what a lot of people consider the absolute holy grail of trading. We are taking a really hard look at the daily candle formula, and we're trying to answer one massive game-changing question. Is it actually possible to predict the market's direction before the opening bell even rings? If you've ever felt that gut punch of entering a trade just to watch the market instantly reverse on you, well, you're absolutely going to want to pay close attention to the research we've pulled together for you today.
Look, it's the absolute bane of a trader's existence, right? You sit down, you analyze the chart, you make your best guess on the direction, and bam, you're stopped out. But what if you didn't have to guess? What if instead of constantly acting as the liquidity fuel that powers the massive institutional moves, you could actually trade alongside smart money? Today, we are thoroughly testing the theory that the market isn't just some random chaos. It actually follows a highly specific algorithm.
Okay, let's dive right into this. Here is our roadmap. We're going to start with the trading holy grail, break down the anatomy of daily candles, look at the liquidity sweep test, define your dealing range, establish premium versus discount zones, and finally deliver the smart money verdict. Starting us off with Section 1, the trading holy grail, moving past the noise.
We've all been there. The extreme frustration of losing trades just because of pure FOMO. You see this massive green candle forming, you jump in because you don't want to miss out, and literally a second later, the market dumps. To move past all that noise, our sources suggest adopting what's called time and price theory. We're basically building a structured algorithm together, piece by piece. This theory states that the market actually tells a crystal clear story before the candles even really form. And there are 4 exact steps to this. We identify candle anatomy, find liquidity sweeps, strictly define our dealing range, and then find equilibrium. If we follow this, we supposedly get a dead accurate direction for the day. So let's break down step 1.
Section 2, Anatomy of Daily Candles. The fake move. The absolute first thing you've got to wrap your head around is that the market almost never moves in a straight line. If you expect it to, you are walking straight into a trap. It usually kicks off with a highly deceptive fake move. Take the bullish OLHC pattern, for example. That stands for open, low, high, close. The market opens, creates a fake move down to trap eager sellers and snatch up their liquidity, and only then does it rocket up to its actual high target. The bearish OLHC pattern does the exact opposite. It opens, spikes up to create a temporary high that traps buyers, and then completely crashes down. You are either anticipating this trap or you're falling for it. There's really no in-between. Which brings us to a pretty harsh but totally necessary reality. It's perfectly captured in this quote from our sources. Stop being the fuel and start waiting for that fake move to finish. You kind of have to think of the market as this giant magnet, and retail traders' stop losses are the fuel. If you don't recognize that OLHC or OHLC trap forming right at the open, your capital literally becomes the fuel that the big players use to drive the market where they wanted it to go all along. You just have to wait out the fake move.
Moving on to Section 3, the liquidity sweep test. Yesterday's clues.
Okay, so we know the fake move happens, but where exactly is it trying to go? Well, the answer actually lies in the past. Specifically, yesterday's price action acts as a literal roadmap for today's market direction. The market acts as a giant magnet, constantly hunting for external liquidity. That means price is naturally drawn to those huge pools of stop losses that are just sitting right above the previous day's high and right below the previous day's low. If you're sitting at your desk and you don't know exactly where those specific stops are resting, you're basically operating in the dark. And this builds into some strict testing parameters to determine our daily bias. Here's how it works. If price sweeps yesterday's low, meaning it dips below it just long enough to grab that liquidity, but then it closes back above that low, our bias becomes solidly bullish, and our target, yesterday's high. Conversely, if price sweeps yesterday's high and then closes below it, our bias is bearish, and we target yesterday's low. So the absolute crucial takeaway here is that a sweep, followed by a rejection, is your clear trigger. Next up is Section 4, defining your dealing range, the safe playing field. Now let's talk about one of the most powerful tools in this whole explainer. We need to establish a safe playing field to filter out all that intraday noise. A dealing range isn't just picking any random high and low on the chart. It's a fresh leg of price action that is confirmed only after the market hunts liquidity on both sides. It absolutely has to take out a high and it has to take out a low. Once both of those sides are cleared, that range is locked in. Why does this matter so much? Because the theory states price will stay inside this specific range until it hits a higher time frame objective. This completely eliminates that awful emotional stress of watching a mid-range spike and panicking, thinking the whole trend is changing. If it's inside your dealing range, you can relax, it's just internal noise.
Section 5. Premium versus discount zones. Where to strike.
So we know the daily candle traps, we know where the liquidity sweeps are, and we've firmly defined our safe dealing range. Now we just need to know exactly where to execute. And this brilliantly illustrates our exact trigger point, 0.5. To find out exactly where to strike, you take a modified Fibonacci tool, set it only to 0, 0.5, and 1, and you pull it across your newly confirmed dealing range. That 0.5 level is your absolute line of equilibrium. It slices your playing field perfectly in half.
So we essentially chop our playing field in half, and we separate our rules for execution. The area above that 0.5 equilibrium line is the premium zone. It's expensive. Therefore, your strategy is to look for only sell setups in this zone, never buy here. Now, the area below 0.5 is the discount zone. It's cheap. You only look for buy setups down here. It is a ruthlessly simple rule, but it works. Institutions do not buy at expensive prices in the premium zone, so why on earth should you? Setting this single boundary is what saves traders from those absolutely disastrous FOMO trades. Bringing us to our final section, Section 6, the smart money verdict. Patience pays. We've assembled the algorithm, but does it actually pass the test in the real world? Well, looking at the source material, the data gives a resounding yes. Your accuracy practically skyrockets when you combine that OHLC pattern with a clear dealing range. You effectively stop trading in the dark. But I've got to be honest with you. The true secret weapon here isn't just memorizing the formula. It's ultimate patience. The formula works exceptionally well, for sure, but only if you have the iron discipline to wait for the market to give you that discount before you join the big players. Bias isn't just about picking a direction. It's about understanding exactly who is trapped and patiently following where smart money is headed. Now, if you're ready to stop guessing and actually start tracking these footprints yourself, the source material provides a highly practical next step. You can access the specific daily bias and dealing range PDF right within the Testing Trading Strategy app. This resource actually contains the exact Fibonacci settings required to start marking your own dealing ranges accurately on your charts today. So we've covered a massive amount of ground today and hopefully completely changed how you view the daily open. But having the daily bias is really just the foundation. Are you ready to pinpoint the absolute extremes? To understand how to execute this bias down to the exact hour? Well, that requires mastering kill zones and session narratives, which happens to be the focus of Lesson 10 in our Sources series. The market tells an incredible story every single day. The real question is, are you finally ready to read it? Thank you so much for joining me for this explainer, and as always, keep learning.